such a hard week. Now we're going to do something good. Does investing have to be fundamentally amoral? My job is to help you become a better investor, which often means identifying stocks that can go higher, even if they, let's say, belong to companies that are sometimes morally indefensible. But does it have to be this way? What if business could do well by doing good? That's the thesis of Just Capital, JUST. That's the nonprofit research organization that produces rankings and data-driven tools to help you identify companies that actually try to do the right thing. In a couple of weeks, they've come out with they're going to come up with their top 100 list, and they recently just put out an ETF called, it's ETF JUST. This is so exciting. The crazy thing, over time, most of Just Capital's indices have outperformed their benchmarks. Blew my mind. Maybe you don't need to be some kind of Machiavellian monster to consistently beat the market. Do not take it from me. This is so exciting. Let's check in with Paul Tudor Jones. He's the visionary hedge fund manager and all-around great guy who conceived of the incredible Robinhood Foundation that does so much good for the unfortunate, as well as being the co-founder of Just Capital. Got to learn more about this. Mr. Jones, welcome to Mad Money. I'm very excited to have you. Thank you, Paul. Thank you.
Good to be here. Before I go, you're going to let me go hit one of those buttons.
Of course. Right? You kidding me? That's why we set them up. Have a seat. It is an honor to have you. And I wish people just knew all the great things that you do. And both my wife and I are so proud to even be to know you.
Well, you're very kind.
And this idea that you've done here, I think, is very much in sync and can bridge a lot of Republican, Democrat, can bridge a young and old. I'm going to give you the floor because when I heard about this, and it was from Dan Hesse, mutual friend, it just sounded like such a good idea.
So 5 years ago, it was apparent even then, I think that capitalism needed to be modernized. You could just see the wealth disparity, even at that point in time, was getting something that was causing social fissures and ruptures in our society. Fast forward to where we are today, it's obviously, I don't think I've seen this kind of social tumult since I was a kid in the 60s and 70s. So so we need to change things. How are you going to get social change?
Okay.
So the biggest way is there's a $19 trillion private economy. It's 4 times the size of the public sector. It's 40 times the size of the philanthropic sector. If we're going to have true social change, it's going to come through the private sector. And I think that's where Just Capital comes in. And boy, now's the time we need it. I just saw this. This poll. 51% of millennials from 18 to 29 either don't believe or oppose capitalism.
Don't believe or oppose?
Yeah, your show's going to have a viewership of about 15 in about 10 or 15 years. No, we got to change things.
Capitalism is a force of good. Business is a force of good.
I know, but we're off the tracks, right? You got half the country left behind. So here's what we did. So the way that you change things is that you've got to first go to the American people, and that's what we did. We said, what is it that you want to see that defines corporate justness? And we went 5 years ago. We began polling. Since then, we polled over 80,000 Americans, and we found out from them what are the key drivers in social and corporate justness that define a just company.
Okay, we've got workers, customers, products, environment, jobs, communities, leadership, and shareholders, in that order.
Yeah. So the most interesting thing, and the reason why this is really interesting to your audience, is that if you take the top 3 things that the public cares about, and the first is worker pay and treatment. Right. Do you pay them a living wage? Do you pay them a good wage? And do you treat them well? Secondly, the products, are they socially beneficial products with a reasonable price and reasonable cost? And then
that the customers like.
And then how do you treat your customer along the sales change? Are they always right, which they should be? Those 3 things comprise 60% of the metrics in our index. So then we took those metrics that every year we poll the public and reconfirm. The thing is, we found the same thing. It's the same metrics over and over again. It doesn't make any difference whether women or men, rich or poor, old or young. They all say the same thing. The number one most important, worker pay and treatment.
Well, doesn't it make sense that therefore they get the best people, which therefore produce the best products and therefore produce the best stocks?
All right, and so get this. If you take just those 3 metrics, the other's important. You take those 3 metrics, just like you said, it's a great business model. Yeah. So then we took the 1,000 largest companies, the Russell 1000. We break them up into their individual sectors, and then we take the top half of each sector. Every year we re-rank, take the top half, and that composes the Just Index, which this ETF tracks.
And so our people are watching. If they feel like you do, they buy shares in this. Now,
all right, well, hold on. Here's the great punchline. On average, those companies earn 7% more return on equity than the ones in the bottom half. And of course, you know our returns on equity translates to booyah, higher prices.
Well, you know what this says to me? This is an index with a heart.
Well, here's a chance to do good, feel good, and hopefully make money. Now, I have no idea what this index is going to do in the future. What I can tell you is that his historical performance is that since we've had the index live for the past 2 years, it's outperformed the Russell and the S&P 500 by about 4% and 3.5% respectively. The current constituents have outperformed the Russell 1000 since 2007 by almost 50%. And again, it makes sense, right? When you think about the top 3 drivers, find great people, pay them a lot of money, get them to make great products, treat their customers well. It's a simple, intuitive business model. We just did a paper. So this outperformance, 83% of it, 83% of the outperformance is pure alpha. Okay. It's not momentum factors, it's not value factors, it's not growth factors, it's alpha.
Well, I like that.
Yeah,
I like that. Now,
really
look,
good.
well, I've got you. I have to ask you. I mean, you've been saying, I understand, it's not a bad time to invest in general, right?
Right. So I mean, just in terms of investing, again, if I knew I was going to have an equity allocation, I would seriously, and again, I think the Just Index, gosh, every state CIO who has an environmental social governance component.
This is the way to do it.
I mean, my Lord, this is the one they should be looking at. And I think, again, for them, it's a natural. If you know you're going to have an equity allocation, this should compete with any kind of allocations to any other indices, S&P 500, NASDAQ, Russell 2000, et cetera. If we just think about the stock market, when everyone says, what do you think about the stock market? Are we going to go into a bear market? I go back and I think about the 99, 2000 top, the 06, 07 tops. Obviously, what typically starts bear markets is interest rates get so high that click it. We're clearly going through a tightening cycle.
Right.
At some point, they're going to stop.
Okay.
So in 2000, when they stopped, the market went back and retested the old highs. In 07, when they stopped, in 06, when they stopped, the market went on 18% for another 18 months. So I don't know if we're going to replay it at the same time.
But I don't want. Your message sounds like to me that it's okay time.
I think that you'll have a chance to see the old highs revisited if and when and before we go into a bear market. And so again, I'm thinking through the end of the tightening cycle, the pause, the excitement around that pause, and then I think, boy, then you got to pay attention. Then you got to pay attention. All right. We'll probably rally after whenever they finish. Then you have to pay attention.
Okay, well, we will certainly maybe have you back for a just
Can I just say something?
Sure.
When we need to be back on here is December 11th, the day after these next rankings, because the way we're going to change corporate behavior is you got to quit talking about earnings. We've got to start talking about justness. Okay,
and I hope this is the new world for hedge funds, right? They're so underperforming, they should just be in just capital. I can't. I don't want. Yes. I think it's a great index. Well, you know what? It is just a joy to have you. You're a humble man. I have to say that this man has probably done more for the unfortunate than anyone that I've ever met. That's Paul Tudor Jones, Just Capital founder, co-chairman, and chief investment officer. There's a ton of work, ton of different things that you can learn about the facts, and of course, the companies themselves. Mad Money is back after the break. Let's go hit a button. All right, let's go hit a button. Which one should I hit? Oh, there we go. That's awesome. Thanks, buddy. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.